Hello everyone, warm welcome to Textbook Super Coaching Regulatory Bodies YouTube channel. My name is Madhav Sir. I welcome you all in a very important session, and this session is related to RBI current affairs. As you all know, if you're preparing for the regulatory bodies exam, current affairs are going to play a really very important role, and that too, current affairs related to RBI are much important. So we at Textbook have started with a series of sessions which are live from Monday to Saturday at 6 p.m. and in these 6 sessions in a week we discuss the specific current affairs. For example, today it's Wednesday and on Wednesday we cover the RBI current affairs, and today we will be discussing the important news related to RBI notifications, RBI press release. Along with that, we will be discussing the important updates related to the RBI bulletin. So let's get started with this discussion. But before I start the discussion, may I have a reply in the comment section that I'm audible, visible, everything is fine, we are good to go. So before we start the discussion, I have a very important information to share with you all. And the information is RBI has released the scorecard of RBI Grade B Phase 1 examination. If you remember, last year the cutoff for this examination was 54.75, but this time the cutoff has increased. There are two important reasons for the same. The first reason is number of vacancies. As we know, the number of vacancies are pretty low this time, and due to the number of vacancies which are pretty low this time, the cutoff has increased. Now you must be thinking, so why cutoff increases due to decrease in vacancies? Because RBI generally shortlist 20 times the count of total seats for phase 2 examination, and if we say to this time the total vacancies were 66, that means 20 times of 66, that is around 1320 students have been selected for phase 2 exam. Last time when I'll just take an approximate value, let's say the total vacancies are 200. In that scenario, 20 times means 4,000 students will be shortlisted for phase 2. So 1320 and 4,000, the number of required students to be selected increases. Obviously, the cutoff comes down. So here the moment number of students who are going to be selected for phase 2 were pretty low, because of which cutoff has increased, and this time the cutoff has increased to 67.25. I can even say that this is the highest cutoff since 2021, because in 2021 the cutoff was around 66, then it fell down to 64, and then it fell down to 54, but this time the cutoff is 67.25, which is highest till date since 2021. Is it the highest cutoff in RBI? No, sir. In 2019, the cutoff for phase 1 examination was 122, which shows that it was pretty high in comparison to the current cutoffs. One thing, if you remember, in my general sessions where we were discussing the strategy to prepare for RBI examination, I have told you n number of times that in case of phase 1 examination, you all know that this examination is qualifying in nature, and whenever the examination is qualifying in nature, we should try to give our minimum input in order to achieve the maximum output, and especially for quantitative aptitude and reasoning, these are the two subjects in which students they prepare in a limited manner so that they can clear the sectional cutoff. Last year in 2023, the sectional cutoff was 15% for every section. What I mean by the word 15% for every section, sir, out of 80, 15% basically means it was 12 marks, but this time it is 20 for general awareness. If I talk about English language, it is 7.5, quantitative aptitude 7.5, and reasoning it is 15. As I said in my n number of sessions, that if you want to clear RBI Grade B examination, then your sectional target should be bare minimum 25%. Your sectional target should be bare minimum 25%, and if you are scoring minimum 25%, then you can easily clear the sectional cutoff, but by scoring 25%, you may or may not clear the overall cutoff. You may or may not clear the overall cutoff. So I'll stick with my words. That means whatever I said, that has been followed surprisingly in 2024 RBI Grade B Phase 1 examination, where I said in 2023 and 2022 sectional cutoff was decreased to 15%, but RBI can increase this cutoff whenever required, and this time they have increased the sectional cutoff mark to 25%. If you're thinking that, sir, is it fixed that for next year also it's going to be 25% only? No, it's not fixed. It can come back again to 20 or 15%, but in my career I have never seen the sectional cutoff above 25%. So if you are targeting at least 25% in every section, you can easily clear the sectional cutoff. And if you are targeting more than 80 marks in the phase 1 examination, then you have a great chance even in 2025 to clear the phase 1 examination. Is it clear, everyone? I hope those words where I have clearly mentioned 25%, on my PPT also it was very clearly written 25%, would help you to remember this. And I don't know why, but yes, RBI has followed our expectations of 25%. Got it, guys? Is it clear? I hope we are good to go. Let's get started with the session. Okay. Now let's begin with the discussion. As you all know that this session is a part of series of session which is live every Monday to Saturday at 6 p.m. and today it's Wednesday, and on Wednesday we come up with RBI updates. So today we have a session on RBI updates where we will be discussing all the important notifications, press release, as well as the RBI circulars and even the news from RBI bulletin. If you all are ready, guys, have a courtesy to reply in the comment section so that I can get to know I'm audible, visible, everything is fine, we are good to go. Please reply in the comment section with yes, sir. Here we go with the first news. The first news talks about RBI has presented a notice, or in an RBI notification, it has been mentioned about India's international investment position. Obviously, the datas which are mentioned on the screen are really very important, but before I discuss these datas with you, what is more important to understand? So the term which is more important to understand is what is international investment position, or for that matter, what is net international investment position. Let's try to understand this point. Guys, as we all know that these days investment has crossed the global investment has crossed the nation boundaries, and if I am residing in India, I can invest outside India. Let's say I am investing in US, and an individual residing in US can invest in India as well. So if we are investing in US, for example, you are purchasing shares in a US based company and the purchase has been made in the US stock exchange itself, that kind of investment will be termed as what? So it will be termed as foreign investment with respect to US. Now, when I have invested in US, against this investment, I have received some shares, and those shares are termed as my asset. Those shares are termed as my asset. Is it clear? On the other side, if a US citizen is investing in India and purchasing the shares from the Indian market, and those shares will be on the name of the US investor, so that will become liability. That will become liability on India. That will become what? So that will become liability on India. So when we calculate the asset and liability of a nation, then we get to know about the net investment position. So let's check this out as it is mentioned on the screen. I'm pretty sure you will be able to understand this point. External assets means foreign assets. What is it? Foreign assets which are owned by countries' government or countries' companies or countries' citizens outside India. For example, the Indian companies, for example, Infosys has set up its office in US. They have purchased a land in US in order to construct their office. So that land belongs to Infosys, which is an Indian company, and that will be termed as foreign asset of an Indian company. Got it? On the other side, what are the external liabilities? So whenever we talk about the external liabilities, these means the liabilities India have, the liabilities on India because of the investment or the funds which we have received from rest of the globe. For example, Apple set up its manufacturing unit in India and it purchases a land on which it completes the construction, set up its office and start its operations. Now that land which is owned by US based company but in India will be what? So that will be the asset belonging to US company, and that asset which belongs to US company is actually a liability on us, because whenever they will be selling that asset, Indians or the Indian government or the Indian economy as a whole is responsible to pay back the amount. So this is how we calculate what? So we calculate the external assets as well as external liabilities. Now, these external assets and external liabilities, they can be equal, or external assets can be greater than external liabilities, or external liabilities can be less than external assets. It depends on the situation. Whenever they are equal, we say net international investment position is neutral. Whenever they are positive, that means external assets are greater than liabilities, we call it NIIP positive. And if it is external assets are less than the external liability, that means we have more liability rather than the assets we own outside India, then will be termed as net international investment position negative. Got it? Let's try to learn more on the same. So what is net international investment position? So it basically measures country's external assets and liabilities at a specific time, reflecting its investment value or position in the global market. Reflecting its investment value or its position in the global market. Basically, it's a snapshot. Which help us to identify the gap between investment and liabilities, or I would say it is basically a snapshot which help us to identify the gap between the investment done by Indians or the lending done by Indians, or I would say foreign assets owned by Indians in comparison to the foreigners owing assets in India, or foreigners lending loan to India, or foreigners they are providing funds to India. Got it, guys? Now, moving on to the next point. As I said, it is of two types. It can be positive, it can be negative, and even it can be neutral in some cases. Positive means which authority measures this NIIP? Don't worry, I'll give you the answer for this as well. Which authority measures this, why it is measured, and after which year this measurement has been started, because it was not done earlier. So it is started after the rules and regulations which were introduced by IMF, International Monetary Fund, in 1993, when they have come up with balance of payment and all other different important terms. In that term or in that particular introduction, they have talked about NIIP, and now in India, RBI is responsible to calculate it and present the data. Obviously, calculation doesn't mean collection of the data. Data will be collected from different departments of the nation, and once the data is collected, compilation is done, and then the final data is presented by RBI. Is it clear? XYZ, whosoever has asked this point. So external liabilities, if they are less than external assets, that means our NIIP is positive. If our external assets are less than our external liabilities, that means we have a negative NIIP. Now you tell me, according to you, which one is better, positive NIIP or negative NIIP? What will be your answer on this question? See, whenever NIIP is positive, this means we are owing more assets outside India. This means we are owing more assets outside India in comparison to the liabilities on us. So when our assets are greater than our liability, then it's quite obvious. It is a better situation. It is a good situation for an economy. But if asset is less than liability, that means we have more liabilities. That means we are liable to pay more. we are liable to pay more, but we will be receiving a less amount in the near future, and due to which we can say that a negative NIP is not favorable for an economy. In that case, there are many negative impacts on an economy if your NIP is negative. Let's check out all these details. First of all, if I talk about when NIP has been made mandatory, why it is calculated? So the answer is first initiative was taken by IMF in 1993, where IMF has introduced balance of payment, and during that introduction part, it has made NIP mandatory. It has made what? Sir, it has made NIP mandatory. So if next time if someone asks you why NIP is calculated, sir, it is calculated because now it has been made mandatory by IMF since 1993. Next point is, sir, NIP comprises various components that obviously reflect the financial situation as well as the financial account of the nation. It includes direct investment, that means the direct investment which is done in the country, portfolio investment which is done in the country. It includes the reserves of the nations as well as the other assets. What I mean with the term direct investment, for example, Apple came in India, invested its funds. Picture is oppositely shown. No, I guess you have read it oppositely. You have read it oppositely. External liabilities are greater than external assets. That is why it is negative. Here external assets are greater than external liabilities. You can see the balance. You can see the balance. So it's negative. It's correct. You just check it out again. No worries. Moving to the next point. So direct investment means when a company enters India, invest and start its operation in India, that is known as direct investment. Indirect investment means when the investment is done in the share market, that we call it as foreign portfolio investment. That will be the part of indirect investment. Along with that, we have the other reserves, like we have gold, we have the government securities of, or I would say foreign government securities, even we have SDRs. They will be the part of what? So they will be the part of our other reserves. Moving to the next. So what is the formula? If you talk about the formula, I have given this formula again. I'm giving it to you. That is NIP is equals to external assets minus external liabilities. External assets minus external liabilities. That is the formula to calculate net international investment position. Now, I have a very important point for you. I have an example for you. Let's understand this example and then let's try to understand this concept in a better manner. Read this example. It says, suppose country B trades with various nations and experience annualized growth of 5% annually. Okay. The country holds foreign reserves in international institutions and domestic companies have acquired businesses in the foreign countries. However, during an economic crisis, country B borrowed $150 million from IMF. So country B has borrowed $150 million from IMF. Okay. Additionally, the country asset in the foreign reserve amount to $350 million. Country's asset is what? So country's asset is $350 million. And if I talk about country's liabilities, so country's liabilities is equals to $488 million. Now, what you conclude with the help of this particular example, let's take the conclusion. If I talk about the conclusion, so the conclusion says by calculating the difference between the external assets and external liabilities, we find that the net external assets or the net investment, or I would say the net external assets and liabilities. In that case, liability is more than asset. In that case, liability is more than asset, because what were the asset? So that was $350 million. What was the liability? So that is $488 million. So that means it is negative $138 million, which means it is not an asset, it is a liability. So this negative balance indicates that the country has borrowed more in comparison to what it has lent. So country will be termed as what? In this case, whenever we have a negative net international investment position, we call that country is net debtor. Country B must pay the debt to its creditor within the specified time frame, and once the payment is done, then in that particular case the scenario may change. But currently as per the data, where your total assets are $350 million, your liabilities are $488 million, your liabilities are more than your assets, then in that case you have a negative account, which means your liabilities are more than assets, and in that particular situation we call that country as a net debtor. In a similar manner, India, for that matter US as well, they are in the category of net debtors where the liabilities are greater than assets. Now I'll discuss with you the data as well. But before I discuss the data, sir, what is the importance? What is the importance of this particular term? This term is really very important. The net international investment position. If the net international investment position is negative, that means it is one of the important indicator of financial stability. As we study for a company, whenever a company's assets are less than company's liability, we say that company is unstable, because in case of losses, or in case when company has been declared as closed down or company has been declared insolvent, then the asset which is going to be recovered, or the funds which are going to be recovered from assets, are less than liability. So all the debtors of the company or all the lenders of the company will not be able to recover the amount. So that shows the financial stability of the country. It shows the credit worthiness of the company. But obviously credit worthiness is not calculated alone by NIIP. There are many other factors, like we have economic indicators like GDP, GNP, national income. Then we consider the fiscal policies, we consider the political stability also. But while calculating credit worthiness, NIIP is an important factor. Last is exchange rate. How I want to discuss the term exchange rate with this. So whenever country's NIIP is negative, that means country's liabilities are greater than country's asset. So if country's liabilities are greater than country's asset, that means country is in a weak financial situation. In that particular case, demand is greater than supply. If demand is greater than supply for foreign currency, it's quite obvious the value of foreign currency in the country will be pretty high, which shows that in the international market, exchange rate will decrease. Decreasing means your currency will depreciate with respect to foreign currency, or I would say there will be a huge gap between the foreign currencies or the international currencies with respect to your domestic currency. So whenever NIIP is becoming more and more negative, in that particular situation, the nation's currency depreciate with respect to the foreign currency, specifically US and the US dollar and the other four international currencies which are mentioned. This is the data which is presented by RBI. As you can see, the data, I hope you are able to read it. If not, I'll try to zoom it for you if I can. Can I do that? I'll just check this. Chalo. So this is net international investment position, and net international investment position as of June 2024 is what? So it is minus $368.3 billion. That means our assets are less than liabilities, where in case of asset we include direct investment, portfolio investment, we include trade credits, loans, currency and deposits, and other assets. Along with that, we include the reserve assets. And if we add all of them, the total value of assets of India, I'm talking about foreign assets of India, is $1051.4 billion. On the other side, if I talk about the liabilities, investment done in India, portfolio investment done in India, trade credits, loan received by India, currency and deposits and other liabilities, this total comes out to be what? Sir, this total comes out to be $1419.7 billion. And the difference between the two is $368 billion, which means that India's net international investment position is negative, because of which we say that India is in a tough situation. But has it improved in comparison to the past? Sir, in March it was 361. In December 2023 it was 368 only. So that means it is not increasing, but it is not decreasing as well. So it's somehow we can say it is stable, because our net international investment position is around around $370 billion or $360 billion. Got it? So let's check out the entire data from where we started. The first point says that net claim of non-residents on India increased. So claim increased means earlier it was $361 billion. Now it has increased by almost $7 billion in the first quarter of 2024-25 to what value? So to $368.3 billion, because in March 2024 this difference was what? So it was $361.7 billion. I don't know whether it was 7 or something else. It was around this point only. The rise in net claim of the non-resident during the quarter was because of, increase in foreign owned assets in India, inward direct investment, which is the largest contributor, reserve assets. They accumulated 1/4 of the rise in Indian resident overseas financial assets, and reserves accounted for 62% of the India's international financial asset in June 2024. Remember that the ratio of India's international asset to international liability has improved. This is an important point. What does it say? It says that India's international asset upon India's international liability, this ratio has improved. Earlier, this ratio was 71.3%, but now it has increased to 74.1% in June 2024, which is a positive sign, which is obviously a positive sign. So let's check out the next table, which is important. So the next table shows you the percentage. Assets, if I say highest asset is reserve asset, that means the reserves we have, that reserves comes out to be around 62% in June 2024. Check out the last column. Then we have the second highest is your direct investment, which was 23.4%. In case of liabilities, direct investment is around 38.9%, but the other investment is 41.6%, which is again the higher side. Share of external debt and non-debt liabilities. If I talk about the debt liabilities means the amount which you have borrowed. So out of the total liability, 52% is the borrowing amount and 48% is the investment which is done in the country. This is an important area which you need to remember. So debt liability means the amount which you have borrowed, that is around 52%, and non-debt liability is 48%. This is the investment done. Obviously it is the part of liability, because in the near future when these assets are going to be liquidated, government is going to be responsible to pay for it, but the actual borrowing is 52% and rest 48% is what? So rest 48% is the investment. Next point, whenever we talk about net international investment position, there are two more terms which are related to the same. One term is known as current account and other term is known as external debt. Now the question is, what is the difference between the two? Current account, basically it's an account which is responsible to hold the data or to hold all those transactions which are not impacting the assets or liabilities. For example, import export, all transactions are recorded under current account. Remittances are recorded under current account. Then if I say along with this, in case of current account, we include the flow of income. For example, the income earned by the Indian citizens outside India and Indian companies they are earning outside India, that will also be the part of current account. It states the overall borrowing needs. So the value of current account if it is negative. In order to overcome that negative amount, borrowing is done under the capital account. Current account is equals to net income plus direct payments plus trade balances. But what are external debts? Sir, external debts are specifically related to the amount borrowed overseas. But what was net international investment position? Sir, it is liabilities, or I would say foreign liabilities or international liabilities minus international asset. Why I have taken in this manner? Because for India it is negative. So in order to avoid the negative sign, I'm writing it in this manner. So international liabilities minus international assets. And in case of international liabilities, we not only take the debt value, we also take the non-debt values. But here we only and only focus upon the debt value. So to calculate the total funds or debts owned by the country, external debt is equals to what? Loan from general government plus loan from monetary authorities plus loan from banks. Then all other loans are included under the category of external debt. They are included under the category of external debt. Why this external debt part is important? Because RBI has recently given the data on external debt as well. So at the end of June 2024, India's external debt was, what was the India's external debt? Sir, it was $682.3 billion, which has increased by $13.3 billion in the last 3 months. The external debt to GDP ratio is 18.8%, which was earlier 18.9%. If we exclude the valuation effect, then it is going to be $16.3 billion, but including that, it is $13.3 billion, which you need to remember. Next point is US dollar denominated debt remained the largest component. Obviously, we have borrowed the amount, and the highest amount which we have borrowed has been borrowed in US dollars, which is around 54%. And after that, it is Indian rupee, then yen, and then SDR. SDR stands for what? Can you give me the answer in the comment section? The last one is euro. Loans remain the largest component. So if I talk about the external debt, in the external debt, loans, they are the largest component, and the largest component is 33%, which is loan. After that, we have currency and deposits, trade, credit and advances, as well as the debt securities. So here is the data now. If you compare the data, if I talk about central bank, then general government, then we have the other sectors, household and non-profit institutions, and on the basis of this, the data has been presented, which is on your screen. This data gives you all the components which makes the value of $682.3 billion. Starting from first one, that is general government, then central bank, then we have deposit taking corporations, then we have other financial corporation, non-financial corporation, household, direct investment, intercompany lending is the part that is under the direct investment, and all these are included, out of which long term, that means the maturity is more than 1 year, is $549.6 billion, and short term, that means the maturity, that means the loan which is need to be repaid in less than 1 year, is $132.7 billion. After that, you need to understand these all things, which are again important. External debt on government account under external assistance, non-government debt. So this is the debt which has been borrowed by government, and this is the debt which is borrowed not by the government, but it is non-government debt, which includes central bank, deposit taking corporations, other financial institutes, non-financial corporations, household and non-profit institutions, as well as direct investment intercompanies. This is the data which is important. The last data which is important for you is outstanding external debt by instruments. So I would say special drawing rights, we have $21.8 billion of external debt. In terms of currency and deposit, what is it? Sir, the foreigners opening up accounts in India and they are depositing their foreign currency in India, that is a liability on India. It may be a deposit in a bank, but actually it is a liability on India. It is actually a liability on the nation. So that is $160.6 billion. Debt securities, it is $116.4 billion. Loans which we have borrowed is $225 billion. Trade, credit and advances, $126.6 billion. And direct investment, which is intercompany lending, is $31.9 billion. And this holds the highest percentage, 33.3%. 33%, and out of the total external debt, highest debt is in denomination, that is US dollar, which is $54.6 billion. Sir, if I talk about the external debt over the period of time, in 1991, India's external debt was around $83.8 billion and it is increasing. There is a simultaneous increase, as you can see. There was one time when it has decreased from 484 to 471. Rest all the years, if you see, it is increasing. It is increasing. It has increased from 2023, which was 668. Now it has increased to $682.3 billion. If I talk about the ratio to external debt, so ratio of what? Sir, external debt to GDP. Earlier, the GDP ratio was 28.3, but over the period of time, as GDP is increasing, this ratio is decreasing and it is 18.8%, which was last year 18.9%, which was last year 18.9%. So this is the entire data which you need to remember, and all the data which I have marked for you are important and you need to remember those data. You may have a direct MCQ question on them, or you may have, or you can use these data while writing a descriptive answer. So I hope the way we have discussed a news in much detail, where the term net international investment position is clear to you, current account is clear to you, external debt is clear to you, along with the data is going to help you in answering most of the questions in the examination. Got it? So that will be all from my side. If you want to clear RBI Grade B examination in 2025, we have a one-stop solution for you, where we provide you with structured live sessions, concise and up-to-date study material, mock test not only for phase 1 but for phase 2, including the descriptive mock test, where you will be typing the answers the way you are going to type in your exam in order to feel the examination scenario before the examination. Then test book is one-stop solution. Use code MADHAV to subscribe for this particular batch in order to clear your upcoming examination. If you want to download the PDF of this session, it is available on the Telegram channel. You can join this Telegram channel and I will be sharing the PDF on the same in a while. Thank you so much, guys. Do not forget to like the session. Do not forget to share the link of this session with your friends. And if you are joining us for the very first time on this channel, do subscribe our channel and give wings to your preparation for RBI Grade B and other regulatory body exams. Thank you so much. Good luck. God bless you.